Okay, so since we have not had sessions since the other week because of my health, I've really wanted to do sessions like the other day, but I feel like I wasn't really okay. But I feel like I have some energy this morning, so I think we can spend like the next 40 minutes at least to learn something about the market cycles. I want to remind you something about the market cycles. Actually, we have five market cycles, and then I talk about entry techniques, and also I'll talk about some things to do with refinement. And as I'm talking about entry techniques and refinements, I'm going to consider different cycles on how to do that. Because I noticed there are people who don't know which areas of liquidity to consider, which one are strong, which one are weak, and all that. Then there's the other aspect of patience and risk management. I remember from the last session, I told you guys like the this week we were supposed to cover something to do with risk management, journaling, coming up with a mechanical system and all that. We're gonna still do that, but for this specific session, allow me to share what I had in mind. So, I believe you guys can see my screen. Uh, the four of you are in the meeting. Just confirm to me if you can see my screen.
Yeah, it is visible.
Okay, perfect. So, I'll start by saying this. We have these cycles. We have the following cycles in the forex market. There are actually, I think, there are five. And these cycles, this is something that I've already taught you guys, but for the sake of us mastering and grasping these things, I saw it important just to do a remind. I remind you guys. Hold on, I share my screen. So, all right, welcome, Lenny. All right. So we have the following market movements or other cycles. The first cycle is monthly cycle, which works well with daily time frame, which works well with the daily time frame as the first situational time frame. Are we together? Then the second cycle, we have a weekly cycle, which works well with the 4 hours time frame as the first constant. Sorry, I mean as the first situational time frame. Then we have from weekly, we have daily. We have daily time frame or other cycle, which works well with 1 hour. Then we have 4 hours. We have 4 hours, which works well with 30 minutes as the first situational time frame, 30 minutes. Then another cycle that we have is H1, that is 1 hour, which works well with 15 minutes as 15 minutes as the first situational time frame. So these are there are actually five. One, two, three, four. Yeah, these are the main five. These are the main five. What do you call it? The main five cycles that we have in the financial market, rather in the forex market. Let me just make it a bit bigger. So what I want you guys to understand is this. I notice people don't know how to do refinement, how to coordinate all these analysis in a proper manner. Okay, perfect. So these are the main cycles we have. The first cycle is monthly. The first and the second cycle are the strongest cycles in the forex market. This monthly and weekly cycle, they speak volumes. They show you much, they give you much confidence on taking trades. Then we have daily, 4 hours, and 1 hour. So when it comes to doing long-term and mid-term swings, you should focus so much on monthly and weekly cycles. Sometimes you can consider the daily cycle. So what you're supposed to consider, so in this case scenario, monthly, weekly, daily, 4 hours, 1 hour, they can be constant time frame depending on the situation or depending on the scenario that you are analyzing your market from. All these cycles, they can allow you to do whatever you want in the market. The way you're going to do your analysis from monthly going to daily, is the way you can do your analysis from 4 hours going to 30 minutes, and is the way you can do your analysis from 1 hour to 15 minutes. The most important thing that you're supposed to consider in the first place is identifying the area of liquidity. I hope you guys are seeing my screen and you're all together.
About volatility being good for
Use the chat section so that I know we are flowing together. So monthly works well with daily. So the monthly time frame is a constant time frame, and then the daily time frame is the first situational time frame. Are we all together? Then from daily now you can go to from daily now you can choose to go to what? You can choose to go to 1 hour. Now this 1 hour, okay, the monthly will show you the area of liquidity. Are we together? So let's say, for example, okay, I think I need to highlight it first of all, just a moment. I'm doing this for the sake of those guys who don't understand. So from monthly, you go to daily, from daily, you go to 1 hour. Then from 1 hour, you go to 15 minutes. Then from weekly, go to 4 hours. From 4 hours, you go to 30 minutes. Then from 30 minutes, you go to 5 minutes. Then from daily, you go to 1 hour. From 1 hour, you go to 15 minutes. I want you guys to understand something. Then from 15 minutes, you go to 3 minutes. There are times you can use 5 minutes. And then from 4 hours, you go to 30 minutes. From 30, you go to 5 minutes. Then from 5 minutes, you can go to 1 minute. Right? Then 1 hour, from 1 hour, 15 minutes. From 15 minutes, there is a time you can use 5 minutes, but from here you go to 3 minutes. Then from 3 minutes, you go to 1 minute. So that's how the cycles moves, or that's how the market moves in the financial market. You really need to understand the aspect of cycles. Once you get this very well, you're going to be able to do things to get in the right way. Now, so let's say, for example, let's pick a random cycle. For me, I like weekly cycle, daily cycle, and monthly cycles. Even when I'm doing anything, I always start my analysis from this time frame so that I get to understand. I'm going to do some practical example using maybe GJ, even if gold. I know gold wiped a lot of people. People are trying to buy. That sell was so good to be true. That sell was really so good to be true because it was the market was not respecting some areas of liquidity. It was just coming and crashing areas of guys and all that. But I'll talk about gold later on because now the market is trying to build up something that will guide us on where to go next. So let's say, for example, we are picking weekly cycle. So when you pick weekly cycle, let's say, for instance, you have a scenario whereby the market has done something like this. Then maybe it has a transition. Then it's going up. Are you together? So let's say this structure that I've drawn here is a weekly structure. Are you together? So once you identify this weekly structure, what you're supposed to do, uh, you need first of all to identify an area of liquidity. Let's say where we have this transition, you can maybe consider this as an area of liquidity. Are you together? So we're going to say this is weekly area of liquidity. So the moment we identify weekly area of liquidity, remember very well, this move that we have here, let me change the color. This move that we have here, if you go to 4 hours, you'll get maybe something like this. If you go to 4 hours, maybe you're going to get something like this. Let me show you. Maybe the market was moving like this. Now, in this case scenario, here, this could be maybe a shift and inside formation. Are we together? So once you identify weekly, if you're choosing maybe weekly cycle, once you identify area of liquidity on a weekly time frame, you now move to 4 hours time frame and look for any shift or any transition that is happening on 4 hours within the weekly area of liquidity. That now will be your starting point of breaking down your charts to other zones. Are you together? So there are a couple of scenarios. There are scenarios whereby you can just find a transition, but you cannot see maybe an inside formation or an outside formation. Maybe you're seeing any type of liquidity at the beginning of that impulsive move, or you can find either both inside or inside and outside formation. And sometimes you can maybe find only inside formation. At times you can find only a shift or a transition with only an outside formation. So whenever you find a case whereby you have both inside and outside formation, you can consider both. You can first start taking your trade with the outside formation. If price doesn't respect that outside formation, you go for the inside formation. If all both formation fails, you know that trade is a failed setup. Are you guys together? But most cases, based on experience, inside formation are always very strong. They work best. All right. Now, once you moved from weekly, weekly is supposed to give you direction and also show you the area of liquidity. The 4 hours is supposed to now the 4 hours, which is your first, the 4 hours, which is your first situational time frame. The first situational time frame after moving from the constant, which is weekly, is supposed to show you sub areas of liquidity or refined areas of liquidity within the weekly area of liquidity. And how do you do that? You either find a shift or a transition within that zone. And then once you find that area of liquidity, what you're supposed to do from there, now you can be able to go to 30 minutes to look for entries. And now when you're talking of entries, what are you going to look at on 30 minutes? You either find liquidity flips. Are you together? Liquidity flips, any type of liquidity flip that you can see, or you can look for liquidity engineering and any type of liquidity engineering. Are you together? Now, once you have identified either liquidity flip or any liquidity engineering, what will take you to 5 minutes is the risk. Are you together? If you find that maybe you can find a liquidity flip or a liquidity engineering on 30 minutes, but it has given you a stop loss that is making sense with a good risk to reward ratio. You don't need to go to 5 minutes. You can end your analysis in 30 minutes and take your entries from there. So long as you're getting your entries near the, when in a scenario whereby, I notice also guys don't understand this. In a scenario whereby you have something like this, we could say this particular point, for a case whereby the market is buying, this particular point is the invalidation, it is the validation point. Then this bottom point is the invalidation, sorry. This bottom point, okay, this bottom point is the invalidation point. That simply means this structure here, the moment the market came and closed maybe above this high that we had here, that was an indication that the sellers have been invalidated and now buyers have been validated. So when the market will come down, we expect price to come and react near the invalidation point and continue buying. But if the market comes and have a body reacting below this or a body closure below the invalidation point, that means again now the buyers have been invalidated now. The sellers are reclaiming the momentum of price. Are you guys following and am I making sense to you? Are you guys understanding what I'm talking about? I need to see the reaction on the chat section. We are 8 of us. I need to see an interactive reaction that I know together before I break down this in a simpler way. So we start with weekly. When you're choosing a weekly cycle, for example, go to 4 hours as our first decisional time frame. From 4 hours, we go to 30 minutes. 30 minutes will help us determine an area of liquidity, an entry, either liquidity flip or liquidity engineering. Are you together? If you find that the stop loss is making sense, now we don't need to go further to the lower time frame. But if the stop loss is so big, we now narrow down to 5 minutes times 1 minute for refinement. At that point, are we good? I'm just using one cycle. I don't need to go through all these cycles. I'm just using one cycle so that I educate you, and then I'm going to do examples or maybe GU and any other pair. I'll show you an example of a daily cycle, our procedure of identifying an area of liquidity, refining from 1 hour all the way to the lowest time frame, talking about validation point, talking about examples of liquidity engineering and the flips, and then I'll show you ideas. Then from there, I'm going to give you assignment. As I said, I just want to do a short session, a reminder session that will help you guys cope up with what you've been learning. Because this is what you're going to use for practice. Before I get deep into risk management and these other things, you must, first of all, understand whatever I'm showing you on the screen. Up to that point, are we on the same page before I go to examples? Are we on the same page before I go to examples? I need to see feedback on the chat section.
Yes, can I speak?
Yes, Nelson.
Yes, I have. I think I had two troubling questions.
Pardon?
I had two troubling questions.
Yes.
So I was asking, in case after finding the area of liquidity, that's where now after finding the shift,
Yes.
and now you have the inside formation and outside formation
Yes.
at the same time. Then also on the top of it, there's also other type of liquidity.
Yes.
So which one do you consider first? That's the number one question.
Okay.
Yes.
Now, this is what I'll say. The first thing, Nelson, that I want you to understand, you must choose a constant time frame to work with. 4 hours can be a constant time frame. 1 hour can be a constant time frame, depending on the case of your analysis. It could be a scalp. It could be an intraday. It could be a short-term swing. It could be a long-term swing. Are we together? So that's the first thing.
Yes.
Once you choose your constant time frame, let's say in this case you have chosen 4 hours. So the moment you choose 4 hours, you need to find or you need to identify an area of liquidity based on 4 hours. Then that's where your analysis starts from. You've identified 4 hours an area of liquidity. Then now you go down to 30 minutes inside that 4 hours area of liquidity and start doing your coordination and refinement. Now, if you find within your for example, in this case scenario, you're using 4 hours. If you find 4 hours an area of liquidity, when you go to 30 minutes, 30 minutes, it's going to give you the story of what happened before that impulsive move happened. So you'll find maybe you have a shift on 30 minutes and you have either inside or outside formation. Sometimes you can lack those. That's why now you can go narrow down to using things like sub areas of liquidities like quick overlaps, which if you move from 30 minutes, you can go and check on 5 minutes, you'll find it as a formation. Then there's a case whereby, I've been talking about these types of liquidity, type 1, 2, 3, 4, 5. So sometimes these formations are types of liquidity. You can find a formation that is a type 1. You can find a formation that is a type 2. You can find a formation that is type 3, type 4, type 5,
Or
whichever.
or order block.
I wouldn't really use the word order block based on how I trade. I don't want to bring a lot of confusion. Just stick to the types of liquidity 1, 2, 3, up to 5. Okay, type 1 can be an order block, type 5 can be an order block, and so on and so forth. But I don't want to use the term order block. So I prefer sticking to type 1, 2, 3, 4, up to 5. Are we together? Now,
Okay.
so I don't know if I've already answered your question. What was the question
Yes,
again?
I get it.
Now, let me go to
Yes.
examples. Let me go to examples and educate you on something. Let me go to examples and educate you on something. Just a moment. I hope you have understood the 5 cycles that you have in the market. And you don't need to use everything. You can decide, we cannot be the same. All of us cannot be swing traders. All of us cannot be scalpers. You can decide if you're so good at scalping, work with that. If you're so good at waiting, whichever way that works for you, better. But I think as far as I'm concerned, swing trading is the best. It is less stress-free, but it depends. There are people who have time, depends with someone. So now I want to use an example. So I want to, you know, I want to use, for example, I'm going to delete everything that we have here on the screen. I can use a different broker. I just want to educate you something about examples of different cycles. And also I might show you something to do with how do you use different time frames to coordinate entries. So let's say in this case scenario, what you have on the screen. So just pick any, let's randomly just pick any what? Randomly pick any cycle. I can choose to pick daily cycle. This is GJ. So, all right. So we understand this recent trend. Okay, we have two things that are happening here. We had this trend whereby the market was selling. Hold on, just a moment. We had this trend where the market was selling. Then you have this trend where the market, sorry, hold on. So we had this trend whereby the market was using the wrong tool. I need to educate you guys. So we had this trend whereby the market was selling, right, up to this point. Let me change the color. Then now we have this trend from down here where the market has been buying. That's how the market moves. Then we have this trend again. We have this trend again where the market has been selling from this point all the way to this level. Are you together? And if you look at it very well, the market was coming to around this point. All right. Now, right now, the most recent trends that we have this trend from here, which was bullish. Then we have this trend from up here to the downside, which was bearish. Are you guys following? All right, we have that trend that has been bearish. And then now, at the moment, we have, when I talk of logic and common sense, at the moment, we have this bullish trend. After liquidity consumption, we have this bullish trend that is happening right now. Are we together? Now, this recent bullish trend that we have, what is happening? This recent trend that we have right now, what is happening? Price is heading to where we have strong areas of liquidity for a reaction before it either continue going up or maybe decides to continue going down. So this is the thing. When I'm looking at my charts on the daily cycle, sorry, I'm just showing you these guys for the purpose of learning. When I'm looking at my charts, the purpose of learning, number one, if I turn my chart into a line graph, I can see there's a high chance price traded below this. We might have a body. Let me see if I have it. Yes, we have body. You see this kind of, let me show you guys. You see, guys, I want you to be keen on this. You see this kind of reaction. This is some sort of manipulation. You see this? It's manipulation because when the market is buying or selling, you see, when this candlestick closed, this bearish candlestick, we expected either the bullish candlestick to open from here and go up, or the bearish candlestick to open from here and go down. But if you look at what happened, are you guys seeing what? If you look at what happened, the body opened just somewhere in the middle, which is a manipulation. So whenever you see such, be keen. This can confuse you. That's why line graph comes in as a way of checking your price. So when I put it here, this is the true lowest point, right? Let me show you. This is the true. Perfect. That is the true lowest point. Are you seeing that? You see it's cutting on the bearish candlestick that closed before we had this. So this candlestick here is a manipulation candlestick, but this one is correct because after this closing, the next candlestick just opened where we had the closing price. You see this one, and then it started going up. But this one is a manipulation candlestick. So you need to be very cautious and keep on that. Are we guys together? Is that clear to you? The only way we can communicate is through you guys commenting on the chat section. That's the only way I can know if you're following. Perfect. So now let's move on. So I was talking about this scenario. We have this trend and then we have this trend. So when you're identifying areas of liquidity where you can get our entries either to sell or buy from, first of all, you see these brokers, they have that the reason why most of the time I use forex.com is because it doesn't have gaps. Like this one, you see there's a gap. But for this case, let me just use this for learning purposes. Looking at this structure, initially when the market was buying from down here, from this particular point heading to this high, right? There were liquidations that were happening. The market was forming structures, come consume it, go up, form another structure, and all that. So right now, from this point, price started forming some liquidation here, went consumed it. If you go to 1 hour, you'll see it, and then it left this area of liquidity which has not been consumed. So probably when this market is going up, it may be coming all the way up to this area before maybe it sells or anything of that. But there's a high chance once price comes here, we'll see a reaction to the downside. Are you together? And maybe go for any unleft liquidity before it continues the trend based on which dominant participant we have in the market based on the constant time frame. Now, so if I look at this chart randomly, I can say clearly, that's why I always tell you guys, market structure is very key. I can say very well, I can clearly state that this is break of structure to the downside. That's why in my classes I teach you guys, you need to understand this is break of structure to the downside, or rather we can call it a shift, either way. So this is a break of structure to the downside. Are you together? Now, that tells us so long as we had a body candlestick closing below this area, or you need to put it on the wick here. That is our candlestick to consider. So we have some body candlestick that closed below this zone. Are we together? Using the daily time frame as our constant. So we could say we have a body closure below that. Hold on. So this is break of structure 2020. That's break of structure, the downside. Then when you look at this chart very well, before this market came and break this, which area of liquidity can we see? We can clearly see we have this type of liquidity, which is a type 5. Are we all agreeing on that? We have this area of liquidity, which is a type 5. Now, this is where we intend to look for some nice sells from. So you need to also know how to use different colors. So for me, I use green for marking my daily area of liquidities. Now, that is our area of liquidity. So now that we have identified this as our daily area of liquidity, where is that? Now that we have identified, this is our daily, AOL, area of liquidity, sorry. Daily AOL. Are you together? That is our daily area of liquidity. So our focus is going to be here to do refinement. This is our area of interest. Even if I put it in a line graph, it shows you this structure here. Are you together? It shows you this structure. So which clearly show you we had a transition and then, so this is more of like an inside formation on daily. If I put my line graph here, this is like shift, right? With an inside. This is like a shift. It's like a shift point. Sorry for that. I don't know why my chart is hanging just a little bit. Okay, this is like my shift point, and then this is acting as my inside formation. Are we together, guys? I need you guys to confirm on the chat section so that I know we are all together. I don't want to, I want you guys to get this clear so that when I give you time to do more practice, because probably starting May, we're going to do a challenge. I think in the next few days, we're going to start a challenge, which I'm going to do assessment. I need you guys to start trading independently, share trades that are valid, make money. Then from there, now we can get into prop farms and do bigger things. Perfect. That means we're all together now. So if I turn my chart back into a line graph, so this is where now we have identified this area. Lucy. Sorry. So this is our area of liquidity that we have identified. Now, when I talk of validation and invalidation points, these, so I don't know if my device is hanging. I don't know if it's my mouse. Just a moment. Perfect. So this point, this particular point, you see this green line, whereby I marked where my body is starting from. When you want to mark it better, you just turn it into a line graph. Then you put it at the tip of that turning point or where the other price surpasses. So this is my validation point. It's where we have our area of liquidity, but this is my validation point. I'll write it here as I will call it just valley. This is my validation point. Maybe I can put it at the, okay, towards the end here, you can see on the screen. This is my validation point. And then this particular point where we have the wick is my invalidation point. Invalidation. Inva. I hope tunaflow pamoja. So that is my invalidation point, right? Now, so we have validation and invalidation point, and we have our area of liquidity. Then we have our, again, guys, nice. You see, this is another manipulation. I want you to be keen on that's why I tell you guys, price action is everything. This is another manipulation. You see here, look at how this candlestick reacted. So we had this bearish candlestick closing here. So we expected if we had a bullish candlestick, it should have started at exactly at this point. Let me show you. If we had a bullish candlestick coming in next, it should have started exactly at this point. In fact, here. You see, so this shift point is supposed to be up, down here. So line graph will give you ideas and then refinement on the candlestick. So shift point is supposed to be here. Then this is the inside formation. So, which has not been consumed on daily. So this is manipulation candlestick. I want you guys to be keen on this. Why I'm saying that, hold on. Look at what happened. Let me zoom and emphasize on that area. You see this candlestick? This one. The moment this candlestick closed here, change the color. The moment this candlestick closed here, this bearish candlestick, we expected this blue candlestick should have started at this black line if it was a bearish. I mean, it was a bullish. Or if it was a, so probably the market, yes, can go down, but the opening price for the bullish candlestick should be exactly where the other candlestick closed. That's why look at how these other candlestick are. When this one closed, the next one opened here and went down. When this one closed, the next one opened and went down. When this one closed, the bearish candlestick closed at where the other one closed. And are you seeing that? So be always keen on this. If you can't be keen on this slight confusion will make you make wrong. You see, this one closed down here, and then the next bullish candlestick opened and went up. Are we all together on that? I hope that one is making sense. According to price action and how we understand the candlesticks, yeah? Oh, the effect, what brings this manipulation is it could be brokers sometimes to confuse retail traders and many other factors. Sometimes because of high impact and volatility. On your different brokers that you're using, you'll see some gaps. There's some weird gaps. It's because of the volatilities that we have in the market. And mostly it happens when we had maybe a holiday and the market is trying to gain back the momentum and all that. But sometimes it's manipulations from the institutions to confuse the retail traders. So that's why I need you guys to be keen on this slight information, slight details to help you so much. So let's move on. So I talked about these shift points, right? Then we have this inside formation, which is a type 5. This is our daily area of liquidity. And then our shift point is down there. So from there now, from down here, so when we want to get our buys, I mean our sales, how do we refine our sales and get our entries from this area of liquidity? Are you together? So from daily time frame, we now need to go to, hold on. I just want this session to be a 40-minute session. So if you have questions, ask them as we move on. I don't want to spend a 1 hour here just explaining things. So that is a daily area of liquidity. Then we have a shift there. So what do we need? So from here, we go to 1 hour. Then in 1 hour, we look for either transition and shift within the area of liquidity. So if I come here, number one, sometimes you also need to understand the aspect of liquidity consumption. So I can clearly see still our invalidation and validation points remains intact. Now, where we had the shift on 1 hour, we had these, we have this flip here, right together. You see the market came, took out this. So this is like liquidity engineering, which is going to be a flip. So first of all, we have 1 hour. Market came, took out this near the area of liquidity and went down. So probably before we take this trade, expect when price will be coming back or when the market will be approaching that zone, we might have a reaction here as a liquidity engineering. Let me show you. So that means, so you might have something like this. Price might come to this zone, give a reaction, and you can get some few pips here. You know, depending on the structure that will be printed as this market is bulling up all the way to the upside. So just expect a reaction here. Right together, you can get fast entry here, but I will go for the maximum liquidity consumption zone, or rather, I will look for entries that are near the invalidation points or the entries that are near the furthermost deviation. I hope that is now making more sense to you guys. Now, so at this point, on 1 hour, within my daily area of liquidity, I need to look for any formation. So what I'll do first of all, I can see here, focusing on 1 hour. I think I can remove this black line to avoid confusion. So I can have this here. Then can put my I can have this outside. Okay, we had a shift. Hold on. Want to see this is the lowest point. Fine. Perfect. Taken out. Perfect. So this is where we have a shift point. And if I put it like this, so we have a shift point at this area. So you go back to candlestick, then you put it at the wick. So when you're identifying also a shift point, I want you guys to understand something. You must have at the turning points, we have a body candlestick that closed above this area, talking about this zone, this candlestick. And then when the market came down, we also have body candlestick that closed below this area. So this makes this a valid shift point. So for 1 hour now, near the daily area of liquidity. So this is our shift point. So this is our shift point. Hold on. So this is where we have our shift point, 1 hour. Then, since we have a shift point on 1 hour, what do we have? Inside the area of liquidity daily time frame, we have this outside formation, right? And on this outside formation, we have validation and invalidation point. Put our defense line at the FMD. Are you together? Then what do we have on this outside formation? So you can consider your first entry to sell around this zone based on the aspect of liquidity engineering. So if you measure the pips from here, it's a lot. So what do we do? So we now narrow down to doing refinement at this zone. Are you together? But for me, I might not consider this area. I might go for the extreme point, which is at up here, as an outside formation. Sorry, I mean as an inside formation, because you have a shift outside formation, and then we have this inside formation. So on this inside formation, I can see we have a type 1 of liquidity. Look at this candlestick, the way it closed. This one reacted above, then came down. So I'm going to have my interest around this area. This is now where I'm going to get my, this is where I'll be interested on looking for entries, this particular area. So what do? I'll go to that zone. Of course, if I have my entry at the validation and invalidation point, clearly you will realize the stop loss is so big. So what do? That is a lot of pips. So we cannot use 120 pips for entries. So what we do, we now move to 15 minutes. So I hope you guys are following me and you're getting what I'm talking about. You have this shift in this outside formation. I'm not interested in this. I'll choose the inside formation. So I'll go to 15 minutes from 1 hour. Then on 15 minutes, there are two possible things. Number one, first of all, on the 15 minutes, I still have this type of liquidity. This is type 1. I hope you're seeing how I'm refining it. I can only validate this type 1. Look at this wick closed within the body of the bearish candlestick, and then there's a reaction above it. So other guys will call this an order block. So the normal traders, those guys who trade order blocks, they'll just say, I will put my entry and my stop loss. Look at this stop loss. It's so big. Why should you miss this? No, you're having a stop loss of 100 pips. Even if you're targeting, no, it doesn't make sense to me. So I need to get entries where I can take even within these 100 pips, I can take even 90 and have a stop loss of 10 and all that. So now, once I'm at this particular area, I'm on 15. Are you together? Of course, we cannot take a trade with that. So we go to 3 minutes. I believe my Nini won't allow my because it's a free version, but let me use 5 minutes. I'm supposed to use 3 minutes, but let me use 5 minutes just to show you. So in 5 minutes, it's supposed to be 3 minutes. So in 5 minutes, if I go further, what else can I see? Inside that zone, because I'm looking for the best stop loss, I see we have this type. We have this type what? We have that type type 1. Sorry, type 5. So if you measure the pips from there to that point, it's around 10. So from here, you can put your stop loss to be 15 to, I always say 20, 27 pips, but 30 is also good. So you can have a stop loss of around this area, let's say 27 pips. In fact, it's supposed to be here because this is where we have FMD for this structure. And then we have our validation and invalidation point. So you can even have your stop loss here. So that means you'll have an entry. Let me show you. So when the market will be coming all the way to that zone. So if I go to 1 hour, you realize that your entry is on the wicks. Let me show you. Those two green lines, you see, that's where we have our entry. So those are the entries that you'll see market comes, taps and go, and then you're like, how did this happen? That's how we do the refinement. So I can have my entry around this. Then maybe I have a stop loss of around that, or I can put it to be something like that, extra pips. I saw someone who's been complaining in the group. So with that, I can now target. If I go back to daily, because the liquidity originated from daily, I can now, what will determine my entries is based on the structures that are going to be built up as this market is pushing up. Right together. So maybe I'll have my entries, sorry. Hold on. Let's say something like this. So you'll have an entry maybe somewhere here, stop loss of 15 to 20 pips, near the FMD. Then maybe you can even target down here. That's like 800 pips. That's an RR of 1 to 30. So based on what will be built up as the market is going up. So, and all these. That's what will determine where we're going to be having our. So maybe if it's that, we're going to have maybe our first take profit around this area, second take profit at this area, third take profit, then maybe the last take profit down here. So what will determine if you'll hold that trade is whatever will be happening on the daily. If you see maybe the market has come and traded below this zone, or rather this point, then it has, of course, it will go for the areas of liquidity that have been created above here, then maybe continue the trend. Price will always go for liquidity before it go. So it has to consume areas of liquidity on 1 hour before it continue. So you can use the daily time frame. If price comes and trades below here, if there's a area of liquidity that was left here, you come do refinement on 1 hour, get continuational entries or re-entries. So you already have your first entry here. You have more entries as you go on like that, targeting the main entries. I mean the main take profit. Are you together? Up to that point, have we understood? I was just using daily to break down to you guys and show you how to identify the area of liquidity, then coordinate with 1 hour, refine on 15 minutes, go to 3 minutes, get your entries, wait for the market to do whatever it does, take your entry, apply risk management, and you're done. Mpaka hapo tumeelewa before I do any other example, because I don't want to do a long session. I want to get feedback from the 9 of you. Mpaka hapo, have we understood? Before maybe I do an example of 4 hours on the same GJ. Have we all understood? I was just using one cycle, which is daily, to show you a practical example. So you can choose weekly, you can choose 4 hours, depending on what you're looking for in the market. Now, so I'm going to delete everything. Then there's a couple of trades I have. I believe we need to kirudi normal from next week. I'm going to show you a lot of opportunities that are coming up for swings, midterm swings, and all that, so that you guys can make money with this. So I'm gonna delete everything. So what I'm going to do, guys, I had a problem of over refining. I believe now I get it better. Perfect. I like such feedback. So when you refine, look for a reasonable stop loss. If you get a reasonable stop loss, don't do a lot of over refinement. And then the other aspect is if you're using a bad broker with a bad type account, I think it was Jonah. He's been complaining in the group, oh, he's having nice setups, and actually I verified that he has good setups, but he was using a bad broker. That's why what will determine again your stop loss, it depends on the broker you're using. There's a broker, maybe if you're using a bad broker with bad spreads, instead of having a stop loss of 27 pips, you need to have extra 2 to 3 pips. Are you together? But for me, I use most of the brokers that I'm using, they're zero purely spread. So there are times I can even use a stop loss of 5 pips, but I always try to give an extra 2 to be on the safer side. You can have the worst and painful thing is when your trade hits your stop loss and then drops to your direction. It is very painful. Two things. It's better even to miss a trade, but the one that hits your SL and goes to your direction, it pains much more than a heartbreak. Anyway, that was just a scenario. So I want us to look at an example of 4 hours. Then I'll look at maybe other examples later. I might not look at every other trade. Remember, I'm not here to do analysis. I'm here to show you. Okay, it's more of analysis, yes, but I'm here to show you ways on how to do it. So if you thought that I'm doing analysis for you to get trades, I'm not doing that. I'm just doing it for the learning purposes. I hope that is clear. So that when you're on the chart alone, you can do things. Now, once you understand this, I expect a lot of what do you call it? I expect a lot of oh, the good thing is I've been using this broker, so I can go to a different broker. So let this remain here so that I'll use it in the next session. Let just this remain here. Let me go back to forex.com. So it's very important when you're using these higher time frames, you consider checking different brokers like Ohanda, FXM, and forex.com. So now let's look at an example of a weekly cycle. Sorry, a 4-hour cycle. We're using now 4 hours as our constant time frame so that we can break down and get a chart. So if you look at the recent trend, so if, for example, I'm on GJ, look at the screen, engineer. I'm currently using forex.com. So I'll just click on GJ. Then I'll come here and select. You see, we have Ohanda, is the first one, FXM, and all that. So the pay is GJ, yes, but I can choose to go to Ohanda, do my analysis, or compare things. Or I can choose go to FXM, all right? Sometimes I do that to check on any hidden information, or I can go to whichever, forex.com. I hope that is answered. So when you look at your chart very well, we have this recent structure. And clearly we can see that the market has been trying to buy from down here. The market is trying to buy. Are you together? And if you look at it very well, you will realize that we have a body candlestick that has closed below, or sorry, I mean above this particular point. You see here, that is the wick, and these previous daily candlestick, it has closed above this. Right together. But my interest is not on daily, I'm interested on 4 hours. So when you come back here, so we can identify, I'm just teaching you guys how to do things right. We can identify, we had a shift point here. If you remember the analysis that we did, I think, was it on Monday, Tuesday? We had a shift point here. And I told guys, the market will be coming down here soon. And maybe before it moves moves up impulsively. Are you together? So just know that market will be coming soon here before you buy impulsive. But now, if you look at what is happening, price traded above that, it has formed this area of liquidity. All of these. Let me show you on the line graph. It's formed this area of liquidity. And hold on just a moment. Just a moment, guys. Just a moment. Just a moment. Just a moment. A moment. I hope you guys are getting things clear now. Right. So when you look at this is 4 hours, price did a shift here. Then we have this imbalance candlestick. So if I put it back into line graph, this is a transition, but this transition down here does not really have anything serious. If I go to 30 minutes, you will see. Yeah, so we have a flip here that caused this, or rather liquidity engineering. But now I'm talking about this area of liquidity from up here down to this one. So all of this is an area of liquidity. All these on 4 hours. Are you together? But I'm going to refine it to you. Why am I saying that? Number one, if you look at what happened, we had price, and I expect price, guys, as much as this market is buying, just know that we are going to sell massively before we continue buying to come back to where we were intending to come, which was our up here, which is our daily area of liquidity before we now again sell. So just know that we're going to be coming here, or this market might come all the way up here, then come down. It depends. The structure will tell us. The structure will give us details. So now, so we have these shift here, have this shift point. Then with this shift point, we have this inside formation, whereby we have that validation and invalidation point. And if you look at the all of this zone, the market has not done full consumption right together. It has not even done more than 50%. So just know anything can happen and price will come here, go up or come here, take everything and even go to this level down here. Remember we did a refinement. There's a zone here. Maybe it will come do something like this. Price might come down here, go inside, then come down, then go up. Then from there, down. Once you understand the liquidity convoy cycle, your life will be better. I always keep saying that, guys. Once you master the liquidity convoy cycle, your life is going to be very, very interesting, guys. So then the market might come down all the way down here. Right together. So the market might come down there. So I wanted to use the 4 hours. I wanted to use the 4 hours to educate you guys on something. So we have this area of liquidity. And since you have this area of liquidity, for now, based on what you can see on the screen, price did that, came tapped on this, but not done a full consumption. Then after that, we can see before market came to break this area up here, also there was something that was done here. We can see, that's on 4 hours. We can see we had we had a transition here, right? We had this transition, and this transition has got an outside and inside formation. So we have this area of liquidity here, right? We have this area of liquidity. We put our lines at the validation and invalidation point. So again, what clarify that if you look at this candlestick here, so long as the body closes above that, then this makes this a valid area of liquidity on 4 hours. So if I turn it to line graph, you'll see we have this. So you go back to refining it at weeks. I think, guys, now that I'm resuming, my health is coming up a little bit stronger. Gonna be meeting wale watu wangu wa physical, tutapatana tu, msijali. So we have here now. So we have identified this recent structure as an outside formation, which is an area of liquidity. Are you together? Hold on. So you have identified. Are we guys together? Nataka nione 10 reactions. Are we together? Nothing complicated. Are we together? We have identified this as an area of liquidity, which is an outside formation on 4 hours. Together is what, engineer? We check on God. You know, I was observing God. Oh my goodness. I hope price will come to my area of interest. I really need to get these buys, guys. I'll explain this trade also. I really need to. Price has reacted actually on this. Let me see. Price has reacted on this. So price, it doesn't touch this zone. So which means yeah, price does not touch this formation. So just know, even if you're taking buys, sales are coming. Maybe the market is coming for this inside structure. Then it drops. That is 15 minutes, okay. The market is coming for this structure. That's a type 5. Then from there, maybe we, there are two possibilities, either this or this. You need to think in probability when it comes to trading. You must think logically, so long as you know the guiding concepts, right? Something like that can happen. But anyway, let's continue with, let's be focused. Let us not lose focus. Let's be focused. So you are on GJ forward area of liquidity. Perfect. So you are here. Now, this is our area of liquidity on 4 hours. Are you together? So how can we get a trade from this zone? So remember what I said when we started the session, guys. I talked of constant, situational, liquidity or flip engineering time frame. Then the lowest time frame is entry whenever your stop loss doesn't make sense or when the risk is too big, right? I think that is on check. Then when we are, before this market did this move, if you go to 30 minutes, you'll see a lot of details. Before this market, when it sold and then bought, on 30 minutes, you'll realize there were some structures that were being created, all that. So that's why we go to the first situational time frame for clarity and understanding. Are we together? Now we come to from 4 hours. So this is our 4 hours. 4 hours AOL as an outside formation. Then we now come to the first situational time frame, which is 30 minutes. We put our focus here. Oh, sorry. So these are our 4 hours area of liquidity. So I can now come to 30 minutes on our area of liquidity. You see, on 4 hours, this was just one move, but on 30 minutes, it shows a lot of information. So inside this area, what do we have? Number one, I cannot see I can't see any type of liquidity, all right? I can see we had a transition, which was at around this area. It's a very nice transition. But I cannot, so we pull it all the way to this zone. So I hope you're seeing, use the line graph and then I put on the wick and the body. The body has to close either up to the downside, wick to body. So I have a transition here, but I cannot see any area of liquidity or any type of liquidity. But now there's another thing I'll be teaching you guys. Whenever you see something like this, then you have a momentum candlestick. It's an important zone, but let us not focus on that. Let me go to the stick to agglomeration one. So now with this, I can see we have liquidity engineering where, you remember we are in the first situational time frame. So we have liquidity engineering here. Is that clear, guys? Why am I saying this liquidity engineering?
Excuse Coach.
Yes.
Is that not the black one and the blue one? Is that not a type of liquidity?
Which one?
That area on the left where you've just drawn the shape on the left hand side, the black, the first and the blue one,
Are you talking about this one?
where there's shift, you see
Oh,
they
this
are
shift.
not the yes, the other on the left, the black one, the tall black one and the bluish.
This one?
Yes, that black and the one on the
Yes.
left. Is that not
It
type
is
of
a
liquidity?
it is a type of liquidity, yes, which is a type 5. Look at the
Five, yeah.
candlestick reaction. But now the question is, we are looking for buys. And we will look for buys from, we are supposed to focus, our entries should be focused on near the furthermost deviation, or rather nearest in this case, nearest the invalidation point. That's where we're supposed to get our entry. So on 30 minutes,
Okay, I
this is where
get
we
you. I
have
get
our shift, rather our transition, sorry, our transition. You can see it here, but I put it on the wicks. So we have our transition. Then down here, what else do we have? We have, when I'm talking about this is liquidity engineering here. And this is a normal liquidity engineering. Why? Before the market did whatever it did first, price formed this low, right? I don't know why my thing is hanging my chart. So we had this low, then we had this high. I want you to be keen on this so that you get it. We had this high. What happened? First of all, the sellers came and took out the buyers. Then later on, the buyers went and took out the sellers. So this becomes our what? Liquidity engineering. So if you measure the pips and they're making sense to you, you take the entry from there. So if I put my stop loss there, I mean my entry and my stop loss here, it gives me around 19.7 pips, which is not bad, right? So that means I'll put my entry around on this black line and go on. But if I need to refine further and maybe I reduce my sell, I now move. So I don't need now this because you already identified the area of liquidity. I now move. To, let me remove all this data. I now move to 5 minutes, and if I can find any more valid reason, I'll use it. Perfect. In fact, okay, we can have our entry there. So long as the stop loss is making sense, I don't need to do much refinement. But if you need to do further refinement, you can come and consider, let me go back to 30 minutes. I'll show you something. Because this was a transition, it's important I show you this. Move this area of liquidity here. So because we had this transition here, there's something I've not taught you guys about FTA. Once I teach you guys will be dangerous in the market. I'll show you. I don't need to rush anything. So that is the FTA. Sorry, I mean that is a transition. So if I go to 5 minutes, remember we already have our liquidity engineering here, right? So I can label it liquidity engineering. Liquidity engineering. the liquidity engineering. So that's liquidity engineering. That's where you're supposed to have our entries, and then we go to 5 minutes. Now, on 5 minutes, you see here, on 30 minutes, we had this transition, but now this transition has several areas of liquidity. So we have this, which has also not been consumed, and we have this. So for me, I'll ignore this, expect price to react here, but now I'll go for the liquidity engineering. On the liquidity engineering, we have a structure, and the structure I'm talking about is this one, right? Is this one, which is a type 5. Are you together? So if I measure the pips, I can choose to consider having an entry there and stop loss here of 8 pips. But for me to be safe, if I don't need to use this, I can still go further. I can still go further. You see this structure that we have down here? This structure, it has, that's on 5 minutes, it has a liquidity engineering here. So you can still do refinement up to that and take your entry at this area. If you measure the pips, that is like 7. So if you put it maybe 20 from that zone or 15, you're still safe. So let's say 15 pips. So you can have either, you can decide, let me show you. You can decide. This is where now sometimes it depends with you. You can decide to have your entries here and have your stop loss at that or 20 pips or even wherever. Or you can choose to go for this refinement. If you do refinement, a lot of refinement, sometimes you can miss the entries, or the market will just come and tap this and go. But since we have this liquidity engineering on 30 minutes and the stop loss was making sense, I need to go to 4 hours and I show you where the entry is on 4 hours. That will get clarity and get on that. So long as the entry is on this on the what do you call it? Nice. If you check on this, it is showing you the entries near the week overlaps. So if I go back to 4 hours, I want you to see what happens. The entries is on the weeks of the constant time frame in this scenario. So you can have your entry, you can decide to do this, or there's what you call buffing. You can decide to have your first entry there and have your stop loss here, or an extra of few pips. Then you can also decide to have an entry around these. That one, a stop loss of 15 pips from there. Then you target, your first target should be maybe around this area. Yes, something like that. Yeah. So something like that. Something like this. Something like that makes sense. So up to that point, have we understood how I got my entries from pain of liquidity coming to flips, engineering, refinement, entries, target, and all that? So do we have a question? Do we have a question? So in fact, these entries, make sure you have them. These are valid entries, but you need to observe price and see what happens also on daily time frame. You see the reason daily candlestick is coming nice. So if this market candlestick comes here, it might come tap here and go and aim up there, so long as price. Anyway, do we have questions? Have you understood? If you have understood, let me know what you've understood on the chat section. If there's something that you're not getting clearly, I believe right now you got clarity. So what I want you guys to do, each one of you, the 9 of you, I'm gonna take a screenshot of the people who attended this session that I'll be able to follow up. But everyone should do this because I'm going to share this recording. Take a picture. The 9 of you, actually the 8 of you, excluding me, I want you to go back to your charts, pick 3 pairs, do examples of 4 hours daily cycles, daily cycle, 4 hour cycle, even 1 hour cycle, weekly cycle. Okay, do daily 4 hours and 1 hour. based on what I've just shared in this session, this is an assignment I'm giving out. So even those guys who are going to watch this recording, I expect you to do the same assignment. So do whatever I've explained in this video, and then break down everything, take those screenshots systematically in that order that I've done it. Go to the Discord server where we have Ask the Mentor, share your work there. I'll be checking out as you go on. So do at least in each cycle, daily, 4 hours, 1 hour, do at least 5 examples. This is not a punishment, it's a way of helping you master this. At the end of the day, you're going to benefit. You're not helping me in any way, you're helping yourself. So if you take it as a punishment, it's up to you. But if you're seeing it as a way of helping you grow, it is an advantage to you. Me, I don't need this. I already mastered all these things. I know how to do them. Even if today I decide to switch off my social media and disappear, I'll still make money from Forex without depending on anyone. That is the level of confidence I have in myself about how I trade. So whatever I'm telling you, it is up to you to do the work. Share it, the group. I mean, on the Discord area where we have Ask a Mentor. If you feel you have something that is personal and pressing, come to my inbox. I like those guys who come to my inbox. That's the way you learn. People like Akina Wycliffe, Alice, Nelson, let me see, we also have Wycliffe, Nelson, was there's this guy, Jonah, and many others. I like even Churchill. When you come to my inbox and you show a lot of disturbance, it helps me also to be interested in helping you. So at the end of the day, I'll teach you everything. I'll share what you need to know, but success is personal. I like saying that because you have to put in the work. You have to go to the charts. And there's one thing I want to tell you guys. I know previously you have had different mentors, but I'll tell you from experience. The thing of backtesting, you don't need to backtest 10 years ago, 5 years ago, 1 year ago. You can backtest 1 month ago, 1 week ago, and you will get results. The market dynamics keeps on changing. There are so many people are coming into the forex market. The dynamics keeps on changing, but there are principles that remains constant. So you don't need to go and backtest what happened last. You can decide to backtest just this year, January up to where we are, and you prove the concept that the concept works, and you can use it to make money. Are you together? So I think up to that point, I believe you have learned something. I just need you guys to do me a favor. Go to the Discord server where we have Ask a Mentor, type whatever you have learned and do the assignment that I've given out. That way, we'll make a progress. So I will give an update on our next session. I think by the end of this week, I'll be back strong. I thought I was good when let me end this recording. I don't want to be so, can I say other things?